Hi, it's Josh here. I'm going to show you how to use the equity release function to purchase subsequent properties within the platform. So we want to go to add new property, and we want to pick a date as to when we want to add a new property. Say, for example, I'm just going to pick a random date here, and then we're going to type in what the property name is, what structure we want to purchase under, what type of property, and we're going to select the beneficial owner as well. Press continue, and the use of this property is an investment in this instance. And then we get into the portfolio position. So it's identifying what our savings balance is, how much usable equity we've got, and what our available borrowing capacity at this point in time is. If you need to override your borrowing capacity at any point in time, you can just click on the override button. This is particularly relevant for if your broker says you can either borrow more or you can borrow less. You can adjust that at a point in time. So let's just put an intended purchase price of $600,000 in. We're going up to 88% LVR. We're going to use a buyer's agent in this instance. But what we're going to do here is we're actually going to use equity rather than using the $127,000 saving contribution, which is made up of the approximate purchase cost and the deposit. What we want to do is we want to try and alleviate this, or not use this cash here, and we want to use equity, noting that we have a crazy amount of equity here. So we're going to then use equity, and we're going to add an equity loan, and we pick which property we want to remove this from, like take this equity from. And so we're going to top up investment for, and then we enter the details. Now you can add interest only or principal and interest loans to this property, and you will use this strategy quite aggressively when you're in your accumulation phase, and then as your portfolio matures, you taper off on the equity extraction. So what we're doing here is we're saying on the 1st of the 8th, 2049, in this hypothetical scenario, we're going to try and extract equity to cover off on our deposit. So we know because the property has $653,000 in usable equity, we're going to only need $127,000. So we type in $127,000. Now our savings contribution is actually zero. So we've covered off on all of the deposit on this property purchase. We're going to put in the relevant interest rate, and then we're going to put in a loan term in and the interest only period of say 5 years, frequency monthly, and then we save and continue. Now that was the equity extraction. That is going to be secured against investment property 4, which is where we took the topped up the loan as a loan split. And now this loan detail here is referring to the main loan that is secured against the property. So now we want to do it, say, for example, P&I or interest only. We might go interest only, 30 years, 5-year interest only period, monthly, same interest rate, 6.19%. Save and continue. Let's assume that the property's value is $600,000, and we're going to add another growth rate. Let's say 8% and then 5%, and continue. We want to put in a yield, say 4%. Continue. What are the total expenses? $10,000 per year. Save and continue. And what's the depreciation? Maybe $1,500. Continue. Now what we've done is we've actually used equity to purchase investment property 5, which is $600,000. And if you want a summary of the property, you can actually click on the property, and it gives you an idea of all the details. So the property is residential individual name, and it's held as a hypothetical property. Here's the price. Here's all the growth rates here, and we've got all the expenses, current rental income and depreciation, all of the purchasing costs. And then we're looking at the loan structure here. So one of the key considerations is we have loans secured to certain properties. We've actually segmented this. So this is an equity deposit loan, which is used for the property, but is not secured against the property. And so when we're calculating our borrowing at a later point in time, this becomes particularly important. Likewise, this is very useful and handy for better understanding of how the mechanism works. And also when you're having a conversation with your broker, you can say, look, I want to top up using equity from property A to as a deposit for property B, and we can do this. So hope this helps.